Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. I would definitely push you, if you're listening now, to stick around for this entire interview. It's going to be a really, really good one. You'll notice there's been a bit of a lull in content on the channel the last couple weeks, and that is all about to change because today we're kicking off a 10-part series that'll be released within the next 2 weeks, interviewing the best and brightest names in the uranium space. These will be a mixture of shakers, movers, from CEOs to fund managers to big-time investors. And the goal is simple. We want to dissect what's going on in the market, where uranium prices are headed, and how you can get positioned best. So today joining us for part one is Michael Alkin. He's the Chief Investment Officer and founder of Sachem Cove Partners, LLC, which is a special situations fund focused on uranium and based out of New York. Mike, welcome to the program.
Hey, Colin. Thanks for having me.
Yeah, some listeners, I believe, forwarded me an interview that you had done last April that got quite a bit of airtime. I believe it was on Real Vision, and you discussed the fundamentals for uranium and why you were getting into the space.
Yeah.
Yeah, so
I did that, yeah, April of last year, yeah.
Right, April of last year. So what I want to do, I want to start off by getting a background and kind of walk us through your experience and how that led you into such a niche space as uranium.
Yeah, sure. So I started in the hedge fund industry in the middle-ish to latter part of the 90s. And I was, the first many years of my career, I was really a dedicated short seller. Where we would look for companies that we thought were too promotional, that we thought were the fundamentals were breaking down, and we would do that by doing balance sheet and cash flow statement analysis. And if the story didn't make sense, then we'd go out into the field and really just do a lot of primary research. Right, we'd go out and talk to customers and suppliers and vendors and former employees, and really try and put the mosaic of information together. The numbers say one thing, management says another. And then there's the third leg of the stool, which is what's really happening in the real world, right? Because you can make the numbers kind of look pretty sometimes. So that was really the first portion of my career. I did that at a small fund I started out at, and then went up to a big $10 billion hedge fund, and then I morphed into doing both longs and shorts because when you're a short seller, you age in dog years. Because a lot of things just want to go up, and you're fighting promotion, you're fighting the market, which typically wants to go up. So as my career progressed, I wound up becoming a partner at a big hedge fund, and I was there for a number of years and did a lot of still did short selling, and so
Now, Mike, let me pause you for just a second there. Do you mind telling the story you had mentioned to me earlier about that big short and one of the early ones in your career?
Yeah, sure. So early in my career, my first assignment, if you will, and I really knew nothing about the hedge fund business. I knew how to read balance sheets and cash flow statements and income statements, and when the numbers didn't make sense, then you kind of went out and did it. So my very first job, it was that smaller fund, we were looking at the for-profit education space. And, these are schools that provide educations to, typically they would focus on students that were first in their families to go to college. And at that time, the U.S. Department of Education kept increasing the funding available in the form of student loans and grants, but mostly loans. So you started to see a lot of the tuition rates keep going up and up and up, and these for-profit schools would prey on these kids, and I say kids, they were kids at 18, 19, 20, and then working adults, and they would market to them very aggressively, and they would promise high-paying jobs and great placement rates and terrific educations. And as we started just looking at the numbers weren't making sense to us, so we said, well, let's see what's going on in the field. So we went around to different parts of the country and wanted to go through the enrollment process. And I would go out into school parking lots, and I would fly to a city. I'd take a duffel bag with me. I think I'm dating myself by calling it a duffel bag, but I would take construction worker clothes with me, and I would drop by a local paint store and pick up a little quarter paint and throw it on me and dry it up, and I would put the construction clothes on, and I'd go hang out in the parking lot and talk to kids, and I'd say, hey, I'm thinking of going to school here. What do you think? And pretty quickly, people started to say to me, oh, don't do that. The education's terrible. We got ripped off. And it was just constantly hearing that. And then I'd go through the enrollment process, and every enrollment counselor, I would walk in, and you get a local paper, and they were always advertising big. 'Cause the internet was there. It would just really, it was first that wave of for-profits were really pre-internet marketing, so it was big advertisements with guaranteed placement rates and job placement rates and big salaries. So I'd walk in, and I'd say to the admission people, hey, I'm trying to get could I get one of these jobs, $75,000 network engineering jobs? Oh, absolutely. We put people in there all the time. And actually, you're lucky because we have a class starting tomorrow. And if you take the exam, it was the Wonderlic exam. If you take the exam, we will be able to see how you do. And if you do well, we can get you in. But not everyone does well, and it's really tough to get into these classes. And, so they gave you something. They were trying to tease you that there's a class starting, but it's really tough to get in. And lo and behold, I always had the highest test score there was. So lucky me. And there was a class starting the next day, and it was just egregious. And from talking to students in the parking lots, they would tell us, talk to this one. We have someone who went to class. They dropped out of school before they should have been charged, but they weren't refunded, and the company would keep the money. And then also a lot of students said, I thought I got grants, but they're really student loans, and I'm getting buried. And I learned that through the process. So I and other people who were shorting the stock thought, this is crazy. These are people who really want to advance their futures and get into make a better life for themselves, and they're getting straddled with massive amount of student debt. And so we would go to the people that mattered. We would talk to the Department of Education. We would talk to Senate and congressional staffers on the education committees and say, listen, here's what we've uncovered, and here's what we've done, and this is wrong, right? And you need to take a look at this. And for me, Colin, it was great because it was like the art of short selling. There's being right on the fundamentals, but being right on the stock is different. Now, I wasn't in charge of the position. I was just the grunt in the field doing the work. But the stock was in the single digits at the time, and over the course of a couple of years, it had rallied into the high 30s, like $40. But the more work we did, the more conviction we had that, holy cow, there's something not right here. And we would jump up and down and tell anyone who would listen what was going on here. And for a while, this company would report and put up big earnings, and the earnings would go up. And it was not right. They were playing with the numbers. And so we one day, you get to the point where you're like, my God, what can we do? And by this time, some of the people we'd been talking to at the various agencies had stopped returning our calls, and you're like, oh my gosh, all this work for nothing, and we're getting killed on the stock. And then one day, the company was sued by a state attorney general, and the next thing you know, the FBI raided them, and the next thing you know, eventually the stock went to zero. But so for me, early in my career, it was an MBA, a PhD, you name it, whatever you want to say it was in the art of investing, especially the art of short selling. And it really drove home to me the importance of not listening to Wall Street research, understanding what Wall Street research is with regard to where consensus is, because that's what moves stocks higher, is what's the consensus formed by the investment community, whether it's typically the sell side, but what's the buy side thinking as well? Sell side being the brokerage firms who write research, buy side being the investors at the mutual and hedge funds. So what's the consensus? What's the management guiding companies towards? How do they get there? But then you really have to understand, that's great, but it doesn't mean that the numbers are accurate. So to understand how the sausage is made, you have to go out into the field. And it was a great experience for me in terms of putting a mosaic of information together, speaking to students, speaking to former students, speaking to former employees, speaking to industry regulators. And you take all this information and you marry it in spreadsheets. Of course, you're doing your analysis with where does it stack up against what the expectations are for the company and what management is saying. And in a case like that, when the first regulator came in, and went after them, well, that means that company is going to stop doing what they're doing, and it's going to be gradual, and they'll have levers they can pull. But we knew if you were an investor and hadn't done the field work we did, you didn't know if it was just some crackpot AG somewhere, Attorney General in some state, going after them for political reasons. But we knew that wasn't the case because we knew we did the work. So that stuck with me, and that's how my career has always been. It's always been about understanding expectations, understanding buy side, sell side, what the management teams are saying, and then taking that with somewhat of a grain of salt, and then going out and doing the real work. And
well,
as my career. Yeah, I'm sorry.
I was just going to insert that I happen to be reading a book called Confidence Game, how hedge fund manager Bill Ackman called Wall Street's bluff. And that, of course, goes over, as you're intimately aware, the MBIA short, which he got right, but then a similar line of thought with the Herbalife short that it's almost certain he lost a ton of money on. And this all, I think, perfectly dovetails into a similar thing, not on the short side, but with uranium. But please continue with the with how this led you to the uranium side.
Yeah, so that was my bread and butter, right? That was my first job. I didn't go and look for a job. Say I want to be a short seller. When I got there, they had a long and a short fund. They had a long short fund, but then they had a short fund, and that's where I was assigned. And it just was my personality. I'm a contrarian. I'm not argumentative. I mean, I'm pretty chilled. I'm laid back, but I'm skeptical. It's just my DNA. And so I don't typically take things at face value. And, I should have been from Missouri, the show me state. Instead, I'm a New Yorker, but that's my cross to bear. But the, so that was my DNA. And then I went to a really big hedge fund, called Zweig Domena, which was running, I think, about $10 billion at the time, and spent almost all my time on the short side. And, just doing the same type of work, really understanding the fundamentals of what's going on in the real world with each company. And then I had the good fortune to work for some guys out of Dallas, Texas, called Walker Smith Capital. And they were young guys when they started their fund, and it was just a few $1 million that they started with, and they grew to well over $1 billion, their hedge fund, and they put up fabulous numbers. And they were very small cap oriented, very value oriented, so contrarian. And through some mutual friends, they were looking for somebody to really help them on the short side, and so that's what I did. And when I was there, these guys they come from Texas, and one of them comes from a Texas oil and gas family. So that was really my exposure to the world of energy, my exposure to the world of natural resources. We worked on some coal stuff when we were there, and it really just kind of resonated with me. The way you make money in these natural resource companies is as Rick Rule always says, right? The cure for low prices is low prices. When things are really ugly is when you want to buy them, and when they're really good is kind of when you want to sell them. Because that was a contrarian way. And as I just kind of kept peeling the onion back, it really just resonated with me. And we loved it there, and my wife and I loved being in Texas. But our first daughter our first child was born, and my wife said, I don't want to stay in Texas. I love the people, but I want to be by my family. So I said, no, we got to go to New York. So that's where we came, and I became a partner at a big fund, and I was there for many, many years, and it did long and short side. It was called Knott Partners. Did long and short, but the same type of work again. And David Knott, who was the founder of Knott Partners, was on the board of some Canadian oil and gas companies, and so more exposure and understanding how all that worked. But I hadn't looked at uranium. I think in 2007 we looked at it when uranium was at its peak, and we looked at it probably as a short. Not probably, we did. And at that time I had analysts working for me, looking at 20 different industries, and sometimes things just fall through the cracks. So we might have spent a few days on it and let it go. And we missed the short, but we hadn't spent enough time peeling the onion back on it, and things fall through the cracks sometimes. And then after Fukushima, after Fukushima blew up, we looked at it again. We thought maybe there's some value here, and again, 2, 3, 4 days, and kind of preoccupied with other stuff, and we were looking at it from the long side, and we let it go, and we should have been shorting it. So then time passes, and in the middle of 2015, my daughter, who she was very sick, and we almost lost her. And the doctors told us she was very, very ill, and she has an autoimmune disease, and something went wrong with an infusion she had. And anyway, next thing you know, I decided that after doing this for a lot of years that I was traveling. I was all over the world traveling, and I just happened to be, when my daughter got sick, I happened to be home. But I could have been in Russia. I could have been in Poland. I could have been anywhere because that's what we invested all over. So I said, I'm going to just, hang up my spreadsheets and take the kids to school and be here. And then over many months, my daughter, thank God, got better. And it was probably 3 or 4 months after that she was home and really getting stronger. And I knew the first time I yelled at her for doing something, I was like, oh, she's back. And I didn't feel guilty for yelling, So it was there. And then I was home. I was just kind of picking stocks with my own money. And I didn't want to go back and work at another hedge fund. I kind of enjoyed being dad. But my wife said to me, why we've been married so many years and have such a great marriage is because you're always traveling, and I've got a routine here. You're interrupting the routine with the kids. And, she said it good-naturedly. But I started looking around, and I said, geez, one day I just said, I was going to look at uranium. I haven't looked at uranium because I was looking on the long side. I look for things on the trash pile, and on the short side, I look for things that are just, this way having huge runs, and I just want to understand why. And I had time. I was home. I have an office in my house. I was home, and time. I didn't have 20 industries I was looking at. I had the ability to sit down, focus, do my own analysis, do my own work. And when I saw that uranium at the time was it had come from several hundred companies, up to 500 companies, down to 50, and the market cap of the industry at that time is probably $4.5 billion or so. And I looked through the institutional ownership, and I saw very little institutional ownership. And I called some of my buddies, some hedge funds, and I said, send me some of the research that the investment banks have. And the stuff I got was really dated or old, or as I started reading through it, it was the buy since 2012. And I thought, probably not many people are going to listen to that buy now after all, these years of being in a downturn. But I realized there was not a lot of attention, and that caught my eye. I said, hey, if it's really hard to generate alpha, right? Above returns above the index. And you've seen over the years hedge fund returns have struggled because there's so many of them, and everyone's chasing the same stuff. They have a lot of assets. And I knew that with a market cap of $4.5 billion for an industry, that half of it being Cameco, I just knew immediately that eliminated the overwhelming majority of big hedge funds. Nobody can invest in the space because it's too small. They would have to own too much of the company for it to be meaningful for their fund, so they're out of the mix. So some really smart eyeballs are not there. Most of the mutual funds not going to be there. Most of these stocks are trading in the cents, right? They can't even own them. So, and then I knew, just from knowing the hedge fund business, that the smaller hedge funds, if you're running a small hedge fund, you don't have the manpower to devote to an industry that is really opaque. There's not a lot of sell-side research. You're not in the business of catching falling knives. When the industry's down 90%, hedge funds are under pressure to perform every quarter. And so they can't wait around too much. Now, some can, and some have their mandate, but most can't. So, again, it intrigued me. And then I noticed that the trading desks, whether it was Goldman or Deutsche Bank, who used to trade the physical commodity, were gone. So I thought, okay, well, let me. How do I think about this? Now, living in North America, being an American citizen, and having only spent a couple of days in the past on two occasions looking at nuclear power. I don't think we even got back then to the point of understanding what's the nuclear power story. So I said, all right, let me understand. Let me first just understand. Let me come at it through the eyes of a short seller. Let me do that type of work. Is nuclear power a growth business? Because my natural inclination was to say no, because we live here in the U.S. and all you hear about is how expensive they are. When they were built, they were over budget, or that they're not economically competitive anymore, and a lot of them are going to close. And you have three-headed dogs because if you have a meltdown. So I really needed to educate myself from the beginning. Because I didn't want to bring my own personal biases into it. And I wanted to understand the role of nuclear versus wind and solar. And so as I looked around the world and I opened the spreadsheet and I said, let me get a list of reactors. Let me find out when they expire. Let me find out how much output they put. Let me go back and look all these years, all the stuff you would do as an analyst. And let me look at the growth curve. And as I started to do that and I started to build out this spreadsheet, what started to jump out at me was pretty quickly, which is known as, well, it's a very bifurcated market in the developed world, in the OECD countries, that nuclear power is not a growth industry. Whether you're looking at the U.S., you're looking at France, Germany obviously is getting out of the business. There's not a growth story there. But as you look at the developing world, it's a huge growth story because they're dealing with pollution, they're dealing with having to get electricity to a lot of people. And nuclear power, as I came to learn, was, and this is, we're talking 3 years ago, right? Nuclear power was it's the cleanest source of energy produced. It's the safest, statistically, it is. And it's the cleanest. It's 2/3 of the U.S. carbon-free electricity. And then as I'm peeling the onion back, I said, hey, wait a second, it's 20% of the U.S. electric grid. Well, that's pretty big. Well, I didn't know 1 out of 5 homes and businesses in the U.S. were lit by nuclear power. And as I started doing that, and then I looked at the role of wind and solar, and I had looked at wind and solar a fair amount in the past because they were subsidized businesses, and that gets a short seller's attention. So I kind of knew wind and solar, and I knew storage costs were high, and I wanted to understand how competitive it was to nuclear, or was it complementary? And I came away saying, you know what, it's more complementary. Where the argument always seems to turn into it's wind and solar are going to take over the world. So I got comfortable with that, and then I started modeling the growth. And at the time, I noticed there were 60 reactors under construction. And I went back and I said, okay, what was the last cycle turn? How many at that time? And there were 23. And I said, well, how many pounds of production were there then, and how much was coming online? And it was a big amount, like over 20% of existing supply was coming online over the next few years. And I saw here, and I'll get into supply in a minute, but it wasn't that same scenario. So I said, okay, now I need to understand. Let me go out and so I've got these number of reactors in the world. Japan's offline. The story had been Japan's coming back online, and it never came back online, or hadn't been coming back online. So let me understand the growth. And as I did it, I got very draconian in my assumptions. I said, okay, wherever there's a country using nuclear power, and there's a possibility for it shutting down reactors, let's use that. Let's do that math. Let's get draconian and say, okay, we're going to take out all these reactors. And I did that. And when I did that, and I only put in, I didn't use the planned and proposed reactors. There's hundreds of them. So I used what was in construction, the 60. And when I did that, I realized that, hey, nuclear power is a growth business. It's going to grow, maybe 1%. With my draconian assumption, I had maybe 0.8 to 9 to 1. If I was a little bit more optimistic and I didn't get so aggressive on the closures, I could see it growing a couple percent. Excuse me. And if I got really aggressive and I started to put some of these planned and they were proposed in, well, yeah, there you go. But at the core, I said, wait a second. You have 12% of the global electric grid. Excuse me. That's big. It's 20% of the U.S. electric grid. That's big. And the commodity is down at over 90%. I think at that time it was probably mid-90s. And it's trading well below the cost of production. And that's a disconnect. Something doesn't make sense. So I said, okay, I'm going to spend more time. And that was 3 months, something like that. I started to get excited. And then it was a matter of understanding the supply side of the equation. And there's not there were some analysts out there, but I didn't do a lot of business with the Canadian banks in the past, so I didn't really get that stuff. But the big U.S. investment banks, they were gone. I mean, if there was a uranium analyst, see ya, or he was going to cover big copper companies or the big global, the majors, and so the data was stale, and it's hard to find data on all the mines. And so that was my next step is, hey, let me model out all the operating mines in the world, and then let me model out all the prospective mines that could come online, and then let me model out the inventories around the world, and let me get my head around that. Now, there's a couple of big sources out there. There's the World Nuclear Association. There's a couple of consulting companies that are kind of the go-to places for information that cover the industry. And as I started modeling out the mines in the world and, each country by country, output utilizations, right, and mine lives, and new reactors coming online that are going to use 2 times the amount for the initial fuel load when they come online, that's a lot of uranium coming online. And then I started really putting my head around really the cost of production, and I started looking at that, and it was significantly higher than where the price was trading. And as I started to do that math, I started to look the primary mine supply and the new projects. I said, well, this math doesn't make sense. Why is the WNA saying there's going to be all this future supply when these projects need $60, $65 uranium? And as I went out and visited people in the fuel cycle, people in conversion, in enrichment, people at the industry associations, and going to these conferences and meeting people, I quickly realized that, wow, the World Nuclear Association uses all these projects that are on the drawing board as though they're future supply. They don't care about the economics. I thought, well, how is that possible? If I have a mine that requires $65 uranium to go on the drawing board, it ain't going in, because as I started to talk to people in the industry, they said, look, the reality is, you've got all these long-term contracts out there, these 7 to 10-year contracts in uranium, because to finance one of these things, it could take 10, 15 years to get them licensed, permitted, and built, and it could take hundreds and hundreds, if not billions of dollars, and the industry is structured on a long-term contract, so the guys financing this have comfort that there's something there, and they're based on project economics that require that type of price uranium to go into production. They're not going to come into production. So I started to say, I think there's a disconnect here. And then I modeled out the inventories. I went around wherever I could get data on publicly traded utilities, and I started looking, going back to 2000, because I thought, when it turned in 03, 04, I thought, well, let me go back and see what buying patterns were before then. And I modeled out the utilities around the world, and wanted to understand. And they don't say on in their reports, hey, here's how many pounds of uranium. It's in process fuel or fuel in reactors. And I wanted to understand, how many years of inventory they have. And I laid all that stuff out, and that took quite a while. And I said, okay, I got my head around that. And let me go find how much is strategic to the U.S., how much is strategic to Russia, best guess. How much is sitting with financial intermediaries? How much is sitting in China? How much is sitting in Japan? What's in the European utilities? What's in Taiwan? Let me get a sense for inventories, and then how much of that is really mobile? How much of that could hit the market? How much of that is not tied in UF6, in enrichment, in fabrication? How much, if a utility needs it, how much can they really get? So started doing that, and then I really, it was focusing on the big 800-pound gorilla in the market that people weren't really talking about, which was the secondary market. And the secondary market is kind of unique to uranium because you have above-ground sources that can be turned into enriched uranium product. And so because if you go back to the mid-'80s, there was not enough uranium primary mine supply to meet the demand. It just wasn't there. So it was filled by something, inventories or secondary sources. And those secondary sources, from 1993 to 2013, when the wall fell and the Soviet Union disbanded, the Americans were concerned that a lot of intercontinental nuclear ballistic missiles were going to wind up in the wrong hands. So they wanted to incentivize the Russians to de-weaponize a lot of these warheads And they said, look, you de-weaponize these warheads, downblend them from highly enriched uranium down to low enriched uranium, and we'll take it for nuclear power. Well, that was 20-some odd million pounds a year, and that's a big number. And that program lasted for 20 years. So that was a big source of secondary supply. And then you had the Department of Energy in the United States at times would sell some of their reserves into the market, or they would barter it. And back in 2013, they wanted to pay for the cleanup of a couple of old gaseous diffusion plants, enrichment plants, and they didn't have it as a line item in the budget. So the Department of Education, listen to me, I'm an old diehard education guy. Department of Energy, they sold they bartered with an environmental cleanup out this uranium, and that was as high as 7 million pounds a year that was coming into the market, and so that was pressuring the market. And during this time, the miners were not cutting production because they thought Japan would come online much quicker than it did. They thought the megatons to megawatts program was ending. They didn't realize the Department of Energy would sell uranium into the market. But one of the big things that stood out to me as I was really focusing on the enrichment side of it, because it's really complicated, was what was taking place in the world of enrichment. Because enrichment's what really matters. If you can't enrich the uranium, it's not going to, unless it's a CANDU reactor from Canada, which there's a handful around the world. They need enriched uranium, and without getting into physics, and it took me a long time to get my head around it, but essentially, if you think about an enrichment plant, when they have slack capacity, and when Japan went down, 13% of world demand went offline. Now, they were taking uranium, but they had a waterfall of contracts. So when a contract would expire, they wouldn't renew it, which meant there was some excess capacity that was out there at the enrichment plants. And when I looked at the number of, they work in units called separative work units. And when I looked at the capacity of separative work units and the demand for separative work units, they had some excess capacity. Now, the newer generation enrichment plants are not like the old ones, which were called gaseous diffusion. The new ones are centrifuge plants, and the cost to operate them is very low. Most of the cost, in the billions, is to build it, but the cost to operate it is really just spinning these centrifuges with electricity. And a new enrichment plant will cost 1/10 the cost of a gaseous diffusion plant. So when they have this excess capacity, because of what they're able to do, when they're spinning the UF6 and the natural uranium through these centrifuges, they are able to, and I'll for layperson terms, I'll say they're able to extract more uranium than what the order calls for. And the way the fuel cycle works, if I'm a uranium miner and I contract with a nuclear power plant, let's say for 5 million pounds of uranium, the only thing that uranium miner cares about is that nuclear power plant gets, in the form of fabricated fuel rods, 5 million pounds of uranium. The only thing the nuclear power plant cares about is they get 5 million pounds of fuel rods to put in the reactors. What happens in the interim is kind of, okay, you do it what you will. Well, when the enrichers have all this excess capacity, they have the technological means to be able to extract more uranium that they could turn into enriched uranium product than the order called for. So a good analogy would be to think about if you had an orange juice maker and you needed to squeeze out a gallon of oranges, you would cut an orange in half and you would squeeze it and you'd get a gallon. If you wanted to get a gallon in a quart, you could probably keep squeezing on it, push down a little bit more, and that extra quart will come out. That's kind of the way that works at the enrichment side. So what would happen, though, is with this capacity, at one point in time, you're probably getting 20 to 25 million pounds of secondary of underfeeding put into the market. That's the equivalent, if you think about MacArthur River, the biggest mine in the world, at 17, 18 million pounds a year. You were putting more than one big mine in the world in a market that couldn't use it. So I started to look at all this stuff, and I said, okay, well, so now I had modeled out the primary mines. I had modeled out the secondary, the prospective projects that were out there, and I got my head around the inventory, and I got my head around the secondary market. The megatons to megawatts had ended, and there's some other sources of secondary supply which we won't get into, but there was probably a 20 million pound surplus, something like that. But one thing that I know just from doing this business for a long time is is that cliche, but it's true, is the cure for low prices is low prices. That an industry that is so important to world electricity generation and to the emerging markets. If you're in China or India, your air is so dirty, you need clean power. And that's what nuclear provides. I just knew that something had to give. Now, the wild card for me was I couldn't get my head around was Kazakhstan. And Kazakhstan had gone from, a few million pounds a year up to producing over 60 million pounds a year. There was a lot of changes that took place in transfer law pricings in the latter part of the 2000s, and they have a lower cost of production over there. Their labor is cheaper. The method of mining they use is called in situ recovery. They use acid over there, a little less concerned about the environment. And they're a state-sponsored producer, and so economics typically can be subsidized by the state if they want to gain market share. So started to really get my head around that, and I started to look at that. And one thing I know from just knowing the energy complex, ISR is kind of like a natural gas well being drilled, and it's a low upfront capital cost compared to a conventional mine like an open pit or a underground mine. But the ongoing requirements, capital expenditures with the well fields and everything else that has to go into it is costly. And as I started looking at the cost curve, I was looking at numbers that were saying that the Kazakhs produce at $10 or $12, and when everyone else in the world, produced in the 30s and 40s and 50s. And I said, I'm not sure that's right. I mean, what's going into those numbers? And as I kept digging, I kind of in my own head said, okay, well, I maybe a couple of places there, but I think their costs are in the 20s, and as they could be as high as low 30s in a couple of those mines, and some of those mines are old, and could they have been high grading the mines? Could they have been during the downturn taking the higher grade uranium out, which is more economic? Yeah, I thought that was a possibility. But in 2014, and cut me off. I feel like I'm just rambling. But if
this is fascinating. Keep going.
Okay, in 2014, the Kazakhs generate a quarter of their state revenue from oil and gas, and the oil and gas cratered in 2014, and they were in a world of hurt, and so I knew that as I started in my own head think, the costs are higher than the conventional cost curve thinks it in, because it's an all-in sustaining cost, not the cash cost, but what's the all-in sustaining cost was much higher, I thought, and the price of uranium was cratering, and that's when I started to think, well, how are they getting by here? How are they doing this? Because you could see the capital expenditures they were spending going back to 2012 to by this time it was 2016-ish. Yeah, that you're kind of getting the numbers. Their capex was precipitously declining. So if they're not spending on those well fields and they're not maintaining at the rate they need to, it's going to be kind of hard to stay ahead of their depletion curve. So I started thinking about that, and what really happened was in 14, 15, they devalued the tenge, their currency, and when it from in the high ones to like 360, 350, I forget the exact number now, but it was like an 80% devaluation, whatever it was an 80, 85% devaluation. That made them cost competitive again, so they were able to cost in tenge and sell in dollars. And I realized that, wait a second, what's going on here is they're not staying afloat in the uranium business because they have these massively lower costs. Yeah, they do. They're lower than everyone else. But the price of uranium was cratering. What was the incentive margin, even though it's a state operator? But they're getting all this help from a currency devaluation. And because of some laws that had changed years back, they were spot market sellers, and you saw the spot market really increase. And so that's really what it was. And I thought, well, you anniversary that sooner or later. And at some point, if their costs are close to what I think they are, they need the price of uranium to go higher. So now as, I'm going through 2016 and I'm looking at all this, I'm saying, okay, the only thing we're missing here in this whole equation for the cure for low prices is supplier discipline. Because you saw all the output increasing, production output during 12, 13, 14, 15, 16 is going up, and I'm saying, what are these miners drunk? How are you increasing production when the price of the commodity has absolutely imploded? And then as you realize the story, it's, hey, the Japanese are coming back online, and the megatons to megawatts is ending, and here we are. And then that was displaced by the Department of Energy's selling, and then the Japanese came on slower, and the underfeeding. And that's when I really surprised me was, as not somebody who spent their life in the uranium industry, is I was having a hard time. When I stumbled upon it, as I went back through all these bull cases, I was like, am I missing something? Why isn't anyone talking about the underfeeding here? This is such a big thing. And so I just really started to think, you just need some sort of supply side discipline. Now, I also was aware, I'm a geopolitical junkie, so I've traveled a lot for investing, and I kind of know the different regions of the world and how they think, and as I really started to peel the onion back on Kazakhstan and just say, okay, let me, I think I know it, but let me really know it. I saw that they were going through they wanted to privatize a lot of companies. So, going into when oil and gas created, that scared the heck out of them. And so they were going on a privatization spree, and they brought a big consulting firm in, and what they really realized was in 2014, 2015 is, okay, here we are, a state-sponsored company. We are 40% of the world market share. We can control pricing anytime we want because we're so big, and yet we are flooding the market with uranium. And the mentality at the time there was really a Soviet mentality, which was produce, produce, produce. That's how you were judged, by production, not profits, but production, produce, and output, keep people working. And the advisors in there said, listen, that's not going to really appeal to the Western folks if you're trying to float these things out to the West. Use your leverage. And one of the things they didn't have was a trading arm. If you're one of the big commodity houses, the commodity producers in the world, you trade your own commodity. The Kazakhs didn't have that. And it really came from the being is part of the transfer law pricing said if you produce something in the extractive industry, you have to sell it into a market where there's publicly verifiable prices, which is spot. And that hadn't really been the uranium market. So anything that they were pulling out of the ground had to go into the spot market. And they could sell it to contracts, but it was spot pricing. And so essentially they weren't able to control the flow of inventory into the market. They weren't able to buy uranium in the market. And part of their advice that they got was you need to set up a trading arm. So like other trading houses, they set one up in Zug in Switzerland, and they were going to launch that, which they did at the end of 2017. And now by having your own trading arm, which is a subsidiary that's capitalized, you can capitalize that with money, and you have the ability to become a swing seller of inventory into the market. You can buy the uranium from your parent company, and then you can decide what you're going to do with that uranium. It can either hit the market or it cannot hit the market. Now, when you're the biggest player in the world and you're trying to privatize and you're trying to improve your numbers, that's a good thing to have. So as I started to really understand that, I thought, okay, this is starting to see some discipline, but still it's a state producer, and I understand that they're not always going to be true to their word because they're worried about their own internal stuff going on in the country. And I just thought, God, you just need to see some production cuts here. And you got that in January of 17. The Kazakhs cut production. They announced a 10% production cut. And I wasn't so sure, still I'm not, that it wasn't a forced production cut. Because if you go back to what I said earlier about the lack of capital spending and the cost that they have, sure, they want to be a good producer. They want to, they want to be more responsible. They want to become privatize these companies, sell a portion to the public. But for other reasons, I thought maybe that was also, maybe the production isn't as great as people think it's going to be. And so we saw that announced cut, and you saw a few other mines start to cut. And then in November of 17, you started to see McArthur River go on care and maintenance, the biggest mine in the world from Cameco. Not care and maintenance. It went on a short-term hiatus. And then that started to really pique my curiosity, because what I had concluded was that I had said, look, here's the mines that are out there that I think are going to have to cut production, and and if they get there, it's meaningfully. I won't share the exact numbers, but it's meaningfully lower than what people think world supply is going to be. And if they get to where I think these companies who have public shareholders are going, they can't pull it out of the ground at 40 or 50 and sell it for 20. They just can't do it. And so when I modeled this out, I said they got to get to this number roughly, and if they get to that number roughly, and the sources of secondary supply, I knew the Department of Energy was pulling back on what they were selling into the market. And as I got through the economics of underfeeding and the design limitations of the centrifuges, which I thought, and the SWU pricing, what the enrichers sell at one point was close to $200 several years ago. They were getting $38, $40 for it, $42 for it. People were thinking, well, the enrichers could keep underfeeding all they want. That electricity is nothing, and the sunk cost is all in building the enrichment plant. But they have a cost too, and it was really hard to get to that cost. But I felt as though we were close, and that the rate of change of underfeeding hitting the market would slow. So I felt secondary sources were going to back off. Primary mine supply, new projects had no chance of hitting that, none, because most of these that were in the pipeline, the licensing has stopped, the permitting has stopped, a lot of stuff has stopped for a lot of these mines. So I thought, okay, if we get primary mine supply cuts, I think secondary supply is going to back off. We're seeing some Japanese demand come back online. I got a sense for what the mobile inventories are. With any production cuts, I think the world's in a uranium deficit, and that's when I started talking about it. I went on Real Vision, and I think it was April of 17. I spoke at a resource conference in June of 17, and people told me I was crazy. I mean, not the uranium companies. They were, nobody paid attention to them for years. So they were, hey, who are you? But I'd spent a couple of years now just quietly looking at this and saying, but it was all I was doing, and saying, I think there's a disconnect. And what, you don't see those a lot, Colin, in your career, because in almost every industry, there's so many eyeballs looking on it. You don't see $4 billion industries that are meaningful. So when you can't have the big pools of capital, what's been moving these stocks around the last handful is retail investors, and they're great. And you get some really dedicated ones, some really smart ones, but they're not the pool of capital that changes that creates an inflection point. It's when do the guys with big pools of money come into the space? Who's the marginal buyer? So I know the margin. I'm sorry, go ahead.
I was going to say, let me pause you there a second, because I think we're at a good cliffhanger kind of moment. We've gone through your background, and we've gone through how you came to the conclusion that uranium was a contrarian investment point at an inflection point. And what we're going to do is we're going to close this off as part one, and then we're going to continue into part two. And I hate to do that to the audience because I know I just want to hear more right now, but we're going to do that. So, Mike, thank you for coming on for part one. And we're
My pleasure. My pleasure, Colin.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?